Hello everyone, in this video I'll walk you through exercise 7.9 from KSO. We'll compute ending inventory using both first in first out and the average cost methods under periodic and perpetual systems and discuss which gives the highest net income. First, I entered all the April transactions. On the left we have the purchases and on the right the sales. Notice that total purchases are 503,000 and the total sales are 4,500 units. So we have 800 units remain in the ending inventory. First of all, under the periodic first in first out method, we assume the first units purchased are sold first. So the ending inventory consists of the most recent purchases. Since 800 units remain, we take 500 units from April 29 at the cost of $6.79 and 300 units from the beginning inventory with the cost of $6 per unit. So the ending inventory under FIFO method is $5,195. Next is under the periodic average cost method, we calculate one weighted average cost for all goods available for sale. So the average cost per unit is $6.35, giving us ending inventory of $5,080. Under the perpetual FIFO, inventory records are updated after every sale, but the ending result here is the same as $5,375 because FIFO always assumes the earliest costs are sold first. Now let's look at the perpetual moving average method. Under this method, the average cost per unit is updated every time we make a purchase. So after each purchase, we recalculate a new average cost by dividing the total cost of goods on hand by the total units on hand. When there is a sale, we use that current average to determine the cost of goods sold by the end of April. After all purchases and sales, the final average cost per unit is $6.4 cents, giving an ending inventory of $5,334. So unlike periodic average cost, which uses one overall average at the end of the period, the perpetual moving average method continuously updates the cost with every new purchase. So that's our results. FIFO gives a slightly higher ending inventory value compared to average cost. In the inflationary period, when prices are rising, FIFO will show the highest ending inventory and therefore the highest net income. Since older, cheaper costs are matched against current revenues. Average cost, meanwhile, smoothes the effect of price changes. Next is problem 7.2, inventory adjustments for Dimitri Company. We'll analyze how each transaction affects the company's inventory, accounts payable, and net sales as of December 31, 2025. The goal is to fix the ending balances so they reflect the correct ownership of goods at year end. The first adjustment is for tools billed to a customer for shipping point on December 31. Even though they were recorded as sold, the goods were still sitting on Dimitri's loading dock, not yet picked up by the carrier. Under FOB shipping point, the buyer owns them once shipped, but since they hadn't left yet, the sale shouldn't be recognized. So inventory is fine, but sales must decrease by 40,000 because revenue was recorded too early. Second adjustment. Goods were shipped from the supplier on December 29 FOB shipping point. That means ownership transferred to Dimitri once the supplier shipped them, even though they hadn't arrived yet. They should be included in inventory and also in accounts payable, since the invoice belonged to December. So increase both inventory and payables by 76,000. Adjustment 3. Work in process inventory costing 30,000 was sent out to an outside processor. It's still Dimitri's property, just not yet physically on site. Because it was missing from the count, we add 30,000 back to inventory. No change to payables or sales. Adjustment 4. Tools costing $32,000 were returned by customers on December 31, but were not included in the count. Since they are back in Dimitri's possession, we must add $32,000 to inventory. Also, because credit memos of $47,000 were issued to the customer, we must reduce net sales by that amount, $47,000. That corrects both sides, the cost and the revenue. Adjustment 5. Tools costing $26,000 were shipped to a customer FOB destination on December 26. Under FOB destination, title passes when the buyer receives the goods. Since the customer got them only in January, Dimitri still owned them at year-end. So we add $26,000 to inventory, but no change to sales because the sale was recognized in 2026. Adjustment 6. Goods costing $27,000 were delivered late on December 31. They arrived before year-end, so they should be included in inventory, but they were accidentally left out of the count. We add $27,000 to inventory. The invoice already included in payables, so no change there. Adjustment 7. Goods received on December 26, costing $56,000, were correctly counted in inventory, but the supplier's invoice wasn't entered yet, so the liability is missing. We add $56,000 to accounts payable. No change to inventory since the goods were already included. The last adjustment is for an unrecorded freight bill of $8,000 from December. Half of those goods are still in inventory, so $4,000 is added to inventory. The entire $8,000 is payable, so we add $8,000 to account payable. The other $4,000 goes to cost of goods sold, not shown here. Let's sum up the adjustments. Inventory increased by $195,000. Accounts payable increased by $140,000, and net sales decreased by $87,000. Adding those to the starting balances gives us inventory of $1,715,000, accounts payable of $1,340,000, and net sales of $8,063,000. So that's the corrected year-end adjustment schedule. The key takeaway is always check the shipping terms, FOB, and whether ownership has transferred. That determines which company should include the goods in the inventory at year-end. Thank you for your attention.